Question 1. Which of the following is a primary responsibility of the Vermont Department of Financial Regulation (DFR) in overseeing the insurance market? A. Setting insurance premiums for private insurers. B. Managing the claims process for insured individuals. C. Regulating the solvency of insurers and financial market conduct. D. Determining health insurance benefits for individuals. Answer: C. Regulating the solvency of insurers and financial market conduct. Explanation: the Vermont Department of Financial Regulation (DFR) plays a crucial role in regulating the financial solvency of insurers and ensuring that they meet financial solvency standards. This includes overseeing risk-based capital (RBC) standards, conducting market conduct examinations, and ensuring insurers adhere to financial report requirements. The DFR also enforces regulations that protect consumers and ensures insurers are financially capable of fulfilling their obligations to policyholders. Question 2, scenario-based. Mr. Adams has been operating as an insurance producer in Vermont for the last 5 years. Recently, he failed to complete his continuing education requirements before the expiration of his license. According to Vermont's licensing regulations, which of the following actions should Mr. Adams take to maintain his license? A. Apply for an extension of his continuing education deadline. B. Submit proof of having completed the education requirements after his license expired. C. Complete the required continuing education courses and apply for a license renewal. D. Stop practicing as an insurance producer until he is granted an exemption. Answer: C. Complete the required continuing education courses and apply for a license renewal. Explanation: under Vermont's insurance producer licensing regulations, all insurance producers are required to complete continuing education to maintain their licenses. If license expires, the producer must fulfill the education requirements and then apply for license renewal. Extensions or exemptions are generally not granted, and complete the required courses would result in lapsed license. It's essential for Mr. Adams to complete his continuing education and proceed with the renewal application to avoid legal issues and ensure his ability to operate as an insurance producer. Question 3. Which of the following is true regarding the regulation of surplus lines insurance in Vermont? A. Surplus lines insurers must operate under the same rate approval process as standard insurers. B. Surplus lines insurance is only available to businesses with over 100 employees. C. Surplus lines brokers must ensure the insurer is licensed in Vermont. D. Surplus lines insurance is exempt from paying taxes and fees in Vermont. Answer: C. Surplus lines brokers must ensure the insurer is licensed in Vermont. Explanation: surplus lines insurance is typically used when standard insurers cannot provide coverage for unique or high-risk situations. In Vermont, surplus lines brokers must ensure that the insurer providing coverage is eligible to offer surplus lines insurance in the state, though the insurer is not necessarily licensed in Vermont. Additionally, surplus lines must comply with reporting and filing requirements, and brokers are responsible for ensuring proper regulatory compliance, including the payment of taxes and fees. Therefore, option C is the correct answer. Question 4. Which of the following is a primary duty of an insurance adjuster under Vermont law? A. To determine the premium amount for the insurance policy. B. To act as a legal representative of the insurer in court. C. To investigate and evaluate insurance claims for settlement. D. To underwrite insurance policies and assess risk levels. Answer: C. To investigate and evaluate insurance claims for settlement. Explanation: under Vermont law, the primary duty of an insurance adjuster is to investigate and evaluate claims made by policyholders. This includes reviewing evidence, determining liability, and assessing the amount of the settlement based on the terms of the policy. Adjusters are not involved in determining premiums or underwriting policies. These are duties of underwriters. Similarly, adjusters do not represent insurers in court unless specifically instructed to do so in particular cases. Question 5, scenario-based. Ms. Roberts is shopping for homeowners insurance in Vermont. She is presented with a policy that includes a clause stating that coverage will not apply for damages caused by floods, earthquakes, or mold. Based on Vermont insurance regulations, which of the following should Ms. Roberts do before agreeing to the policy? A. She should accept the policy as is, since it is standard practice to exclude such damages. B. She should request a policy amendment to include coverage for floods and earthquakes. C. She should ensure the policy includes a rider for mold-related damages. D. She should ask for a policy with a higher deductible to offset the exclusions. Answer: B. She should request a policy amendment to include coverage for floods and earthquakes. Explanation: in Vermont, standard homeowners insurance policies often exclude certain types of damages, including those caused by floods and earthquakes. However, Ms. Roberts has the right to request a policy amendment or endorsement to include these coverages if she believes it is necessary. If the insurer is unable or unwilling to offer such coverage, Ms. Roberts should explore additional insurance products, such as flood insurance, which is typically provided through the National Flood Insurance Program (NFIP), or earthquake coverage through a specialized endorsement. Question 6. What is the primary objective of the Vermont Department of Financial Regulation (DEFR) when conducting market conduct examinations? A. To assess the profitability of insurance companies operating in Vermont. B. To ensure insurers comply with advertising and marketing regulations. C. To determine whether insurance premiums are adequate. D. To evaluate whether insurers are operating in compliance with laws governing claims underwriting and policyholder treatment. Answer: D. To evaluate whether insurers are operating in compliance with laws governing claims underwriting and policyholder treatment. Explanation: market conduct examinations conducted by the Vermont DEFR primarily focus on ensuring that insurers are complying with laws and regulations relating to claims handling, underwriting practices, and the fair treatment of policyholders. This includes reviewing insurer practices to identify or deceptive practices and ensuring that insurers adhere to Vermont's consumer protection laws. These examinations are not focused on evaluating profitability or assessing specific premium amounts, although those aspects can be indirectly influenced by regulatory actions. Question 7. Which of the following statements best describes Vermont's requirements for workers' compensation insurance for employers? A. Employers must only provide workers' compensation insurance if they have more than 10 employees. B. Workers' compensation insurance is mandatory for employers with 3 or more employees, excluding family members. C. Employers can choose not to carry workers' compensation insurance if they operate in low-risk industry. D. Workers' compensation insurance is optional for employers but must be purchased from state-run insurer. Answer: B. Workers' compensation insurance is mandatory for employers with 3 or more employees, excluding family members. Explanation: under Vermont law, employers with 3 or more employees, excluding family members, are required to carry workers' compensation insurance. This is designed to provide financial support for employees who are injured on the job. Vermont does not allow employers to opt out of this requirement even if they operates in low-risk industry. Employers must purchase the insurance from private insurers, though they may be eligible to self-insure if they meet certain criteria set by the Vermont Department of Financial Regulation. Question 8. Which of the following best describes the Vermont regulation on insurers' duties to disclose information to policyholders? A. Insurers must disclose all policy information, including pricing, upon the request of any policyholder. B. Insurers are required to disclose all information relevant to policyholders' claim, including information obtained from third parties. C. Insurers only need to disclose information related to the policyholder's benefits at the time of claim filing. D. Insurers must provide full disclosure of underwriting criteria and reasons for policy denials only when policyholder requests it. Answer: B. Insurers are required to disclose all information relevant to a policyholder's claim, including information obtained from third parties. Explanation: in Vermont, insurers are required to disclose to policyholders all information relevant to claim, including any information obtained from third parties. This ensures that policyholders have full transparency regarding their claims process and helps prevent any unfair or deceptive practices. Disclosure includes details of the investigation, evaluation, and settlement process, and it is not limited to the policyholder's benefits alone. Option B reflects the best practice and legal obligation under Vermont's consumer protection regulations. Question 9. Which of the following describes the purpose of the risk-based capita (RBC) standards established for insurers in Vermont? A. To determine the appropriate premium amounts that insurers can charge. B. To assess an insurer's ability to meet its financial obligations in case of adverse conditions. C. To regulate the types of insurance products that insurers can offer in Vermont. D. To determine whether an insurer is profitable enough to issue dividends to shareholders. Answer: B. To assess an insurer's ability to meet its financial obligations in case of adverse conditions. Explanation: the risk-based capital (RBC) standards are designed to assess an insurer's financial strength and its ability to meet its obligations, particularly in times of financial distress or adverse economic conditions. The RBC formula takes into account various risks, including credit risk, market risk, and underwriting risk. It ensures that insurers maintain enough capital to cover potential losses and continue operating safely, protecting policyholders from financial instability. Question 10, scenario-based. Mr. Hernandez recently purchased an auto insurance policy in Vermont. After a car accident, he discovered that the policy did not cover damages caused by an uninsured motorist. According to Vermont law, what should Mr. Hernandez do to address this situation? A. Mr. Hernandez should file a complaint with the Vermont Department of Financial Regulation and seek a refund for the policy. B. He should review the exclusion clauses and determine if he has the option to purchase an uninsured motorist endorsement. C. Mr. Hernandez should request that the insurer waive the exclusion clause in his contract. D. He is not entitled to any coverage, as uninsured motorist coverage is optional in Vermont. Answer: B. He should review the exclusion clauses and determine if he has the option to purchase an uninsured motorist endorsement. Explanation: under Vermont law, uninsured motorist coverage is required as part of the mandatory auto insurance policy unless the policyholder opts out in writing. However, if Mr. Hernandez's policy does not include this coverage, he should first review the exclusion clauses and consider adding an uninsured endorsement to his policy. If the insurer provides this option, he can request the endorsement to obtain coverage. If the insurer is not willing to provide it, Mr. Hernandez may need to seek additional coverage through another provider or file complaints with the Vermont Department of Financial Regulation. Question 11. Which of the following is true regarding Vermont's regulation on cancellation of personal lines insurance policies? A. Insurers must provide 15 days notice before cancelling a policy for non-payment of premium. B. Insurers may cancel a policy at any time without notice if the policyholder files a claim. C. The insurer must provide a 30-day notice for cancellation due to non-payment of premium. D. Policies can be cancelled immediately without notice if the policyholder violates any policy conditions. Answer: C. The insurer must provide a 30-day notice for cancellation due to non-payment of premium. Explanation: in Vermont, insurers are required to provide a minimum of 30 days notice to policyholders if they intend to cancel a personal lines policy for non-payment of premiums. This allows the policyholder time to remedy the situation before the policy is cancelled. Question 12. Which of the following statements is true about Vermont's flood insurance requirements? A. Flood insurance is automatically included in all homeowners insurance policies in Vermont. B. Homeowners in Vermont are required to purchase flood insurance if their property is located in designated flood zone. C. Flood insurance is not required for any properties in Vermont, regardless of their location. D. Vermont law mandates flood insurance for properties only if the property is located near a river or stream. Answer: B. Homeowners in Vermont are required to purchase flood insurance if their property is located in a designated flood zone. Explanation: in Vermont, homeowners are required to purchase flood insurance if their property is located in a designated flood zone. This is part of the National Flood Insurance Program (NFIP) and is intended to protect homeowners from significant losses due to flooding. Question 13. Which of the following types of insurance coverage is not mandatory for automobile owners in Vermont? A. Liability insurance. B. Uninsured motorist coverage. C. A personal injury protection (PIP). D. Collision coverage. Answer: D. Collision coverage. Explanation: while liability insurance and uninsured motorist coverage are required by Vermont law, collision coverage is optional. Collision insurance helps pay for damages to your car in the event of an accident, but it is not a mandatory requirement. Question 14. Under Vermont law, what is the minimum coverage requirement for bodily injury liability in a private passenger automobile insurance policy? A. $25,000 per person, $50,000 per accident. B. $50,000 per person, $100,000 per accident. C. $100,000 per person, $200,000 per accident. D. $25,000 per person, $100,000 per accident. Answer: A. $25,000 per person, $50,000 per accident. Explanation: Vermont law requires the minimum coverage of $25,000 per person and $50,000 per accident for bodily injury liability in an automobile insurance policy. This ensures that policyholders can cover medical expenses for injuries caused to others in an accident. Question 15. Which of the following actions is a policyholder allowed to take under Vermont's property insurance law? A. Cancel policy without providing any notice if the property is sold. B. Request premium reduction for minor claims made during the policy period. C. Request the insurer to reinstate policy after it has been cancelled due to non-payment. D. File claim for damages caused by normal wear and tear. Answer. C. Request the insurer to reinstate a policy after it has been cancelled due to non-payment. Explanation. Under Vermont law, policyholders may request the reinstatement of a policy that was cancelled due to non-payment, depending on the insurer's policies and the specific situation. However, claims for damages caused by normal wear and tear are typically not covered under property insurance policies. Question 16. What is the primary goal of Vermont's Fair Claims Settlement Practices regulations? A. To ensure that insurance companies offer the highest premiums possible. B. To prevent insurers from unreasonably delaying or denying claims. C. To ensure insurers only pay for the lowest possible settlement amount. D. To regulate the amount of commissions paid to insurance agents. Answer. B. To prevent insurers from unreasonably delaying or denying claims. Explanation. Vermont's Fair Claims Settlement Practices regulations aim to protect policyholders by ensuring that insurance companies process and settle claims promptly and fairly. This includes preventing unjustified delays or denials in claims settlement. Question 17. Which of the following would be considered an unfair claims settlement practice under Vermont law? A. Offering a settlement within the first 10 days after receiving a claim. B. Denying a claim based on the exclusion of a specific peril in the policy. C. Failing to provide a written explanation for claim denial within 15 days. D. Paying the full claim amount as soon as the investigation is completed. Answer. C. Failing to provide a written explanation for claim denial within 15 days. Explanation. Under Vermont law, if an insurer denies a claim, they must provide the policyholder with a written explanation for the denial within 15 days. Failing to do so would be considered an unfair claims settlement practice. Question 18. Which of the following is required for an insurance company to conduct business in Vermont? A. The company must be registered with the Vermont Department of Financial Regulation, DFR. B. The company must operate only in the commercial sector. C. The company must provide a written guarantee of premium refunds to policyholders. D. The company must exclusively write health and life insurance policies. Answer. A. The company must be registered with the Vermont Department of Financial Regulation, DFR. Explanation. To conduct business in Vermont, an insurance company must be registered with the Vermont Department of Financial Regulation, DFR. This registration ensures that the company is complying with state laws and regulations. Question 19. What is the maximum time frame for an insurer to settle a claim under Vermont law? A. 10 days. B. 30 days. C. 60 days. D. 90 days. Answer. B. 30 days. Explanation. Under Vermont law, insurers are required to settle claims within 30 days after receiving all necessary documentation and information. This ensures that claimants receive timely payments for their covered losses. Question 20. What is the purpose of Vermont's financial responsibility law regarding auto insurance? A. To ensure that all vehicles on the road are covered by collision insurance. B. To make sure drivers can cover the cost of damages they cause in an accident. C. To limit the amount of liability coverage required for automobile insurance. D. To enforce mandatory vehicle inspections for all insured vehicles. Answer. B. To make sure drivers can cover the cost of damages they cause in an accident. Explanation. Vermont's financial responsibility law is designed to ensure that drivers can pay for the damages or injuries they cause in an accident. It requires that all vehicles be insured with at least the minimum required liability coverage. Question 21. Under Vermont law, if an insurance company fails to pay a claim within the required time, the insurer is liable to pay which of the following? A. Interest on the claim amount from the date the claim was filed. B. Double the original claim amount. C. A penalty equal to 10% of the claim amount. D. A refund of all paid premiums. Answer. A. Interest on the claim amount from the date the claim was filed. Explanation. If an insurance company fails to settle a claim in a timely manner, Vermont law requires the insurer to pay interest on the claim amount from the date the claim was filed. This encourages insurers to process claims promptly. Question 22. Which of the following is true regarding the Vermont Automobile Insurance Fraud Prevention Act? A. It provides financial assistance to policyholders who are victims of automobile insurance fraud. B. It makes it illegal to submit false or misleading information related to auto insurance claims. C. It allows insurers to automatically deny claims if fraud is suspected without an investigation. D. It mandates that all auto insurers in Vermont must include fraud prevention education in their policies. Answer: B. It makes it illegal to submit false or misleading information related to auto insurance claims. Explanation: the Vermont Automobile Insurance Fraud Prevention Act criminalizes submitting false or misleading information regarding automobile insurance claims. This helps protect both insurers and policyholders from fraudulent activities. Question 23. Under Vermont law, what is the minimum amount of liability coverage required for a motorcycle insurance policy? A. $25,000 per person, $50,000 per accident. B. $50,000 per person, $100,000 per accident. C. $100,000 per person, $200,000 per accident. D. $10,000 per person, $20,000 per accident. Answer: A. $25,000 per person, $50,000 per accident. Explanation: Vermont law requires motorcycle insurance policies to have a minimum of $25,000 per person and $50,000 per accident in liability coverage to protect against bodily injury and property damage caused to others in an accident. Question 24. In Vermont, which of the following would be covered under a standard homeowner's insurance policy? A. Earthquake damage. B. Damages caused by floodwaters. C. Vandalism to the property. D. Damage from normal wear and tear, as in an accident. Answer: C. Vandalism to the property. Explanation: vandalism is typically covered under a standard homeowner's insurance policy. However, damages caused by earthquakes and floods usually require separate coverage through specific endorsements or policies, such as earthquake or flood insurance. Question 25. Which of the following does Vermont law require insurers to include in their insurance policies? A. A clause that allows insurers to cancel policies without notice. B. A summary of the policyholder's right to file complaint with the Vermont Department of Financial Regulation. C. Provision that all claims must be paid within 7 days. D. Requirement that insurance premiums must always be adjusted annually. Answer: B. A summary of the policyholder's right to file complaint with the Vermont Department of Financial Regulation. Explanation: Vermont law requires insurers to include information about the policyholder's right to file complaint with the Vermont Department of Financial Regulation in their insurance policies. This ensures consumers know how to resolve disputes with their insurer. Question 26. Which of the following is a requirement for an insurer to deny a claim under Vermont's property insurance regulations? A. The claimant must fail to provide police report. B. The damages must be caused by covered peril and not an excluded peril. C. The insurer must demonstrate negligence on the part of the policyholder. D. The policyholder must be found guilty of fraud. Answer: B. The damages must be caused by a covered peril and not an excluded peril. Explanation: for an insurer to deny a claim under Vermont property insurance regulations, the insurer must demonstrate that the damages were caused by a peril that is excluded from the policy. Claims cannot be denied solely on the grounds of negligence or without clear evidence of exclusions. Question 27. Under Vermont law, what is the minimum required liability insurance coverage for a commercial auto policy? A. $50,000 per person, $100,000 per accident. B. $25,000 per person, $50,000 per accident. C. $1 million per person, $2 million per accident. D. $100,000 per person, $300,000 per accident. Answer: D. $100,000 per person, $300,000 per accident. Explanation: for commercial auto policies in Vermont, the minimum required liability insurance coverage is $100,000 per person and $300,000 per accident. This coverage is necessary to protect against bodily injury and property damage to third parties caused by the insured's business-related driving activities. Question 20. Which of the following is an acceptable reason for an insurer to cancel a commercial property insurance policy in Vermont. A. The insured business undergoes a change in ownership. B. The insured business has experienced a decrease in property value. C. The business fails to make payments on a loan. D. The insured property has experienced damage due to a covered peril. Answer A. The insured business undergoes a change in ownership. Explanation. Under Vermont law, an insurer may cancel a commercial property insurance policy if the insured business undergoes a change in ownership, as this may affect the risk exposure of the insurer. However, an insurer cannot cancel based on a decrease in property value or damage from a covered peril. Question 29. What does Vermont law require insurers to do if they issue a policy that does not cover certain types of property? A. Provide a refund for any premiums paid. B. Issue a separate endorsement to cover the property. C. Provide clear written notice of exclusions in the policy. D. Pay for the excluded property if it is lost or damaged. Answer. C. Provide clear written notice of exclusions in the policy. Explanation. Under Vermont law, insurers must provide clear and written notice of any exclusions or types of property not covered under the policy. This ensures that policyholders are aware of the limitations of their coverage and can make informed decisions about additional coverage. Question 30. Which of the following is the primary responsibility of the Vermont Department of Financial Regulation regarding insurance? A. To provide insurance coverage for state residents. B. To ensure that insurers operate in a financially sound manner. C. To create new insurance products for the marketplace. D. To set the rates for auto and homeowners insurance policies. Answer. B. To ensure that insurers operate in a financially sound manner. Explanation. The Vermont Department of Financial Regulation is responsible for ensuring that insurers operating in the state maintain financial solvency. This helps protect policyholders and ensure that insurers can meet their obligations in the event of a claim.